Hey guys, welcome to episode 4 of Finance Operators. Today we have a really exciting docket of stuff to rip through. We'll go through the new tariffs, just how bad are they, and then we'll also give you a few solutions on how you can combat those by increasing your prices, not just outright price increases. We'll give you the full toolbox, what's worked for us, what's been kind of tricky, and then we will rip through. We'll cover Thrasio. Drew, what are we going to talk about with Thrasio?
We're gonna break down the model, from sort of start to finish, and how it started and how we sort of think that it's gonna end. We're also gonna sort of touch on like a little bit about consumer confidence and as it relates to tariffs and how you might be able to navigate some of that stuff, inside your own P&L. And then one other thing that I'm pretty interested to learn about from you is just sort of the private equity model of buying a company and kind of integrating it into other sort of parts of the value chain that's owned by that same fund. So this is my theory on what happened with Melo Water, which is a small brand that got acquired yesterday. So
Cool.
we'll go through it all. We'll go through tariffs, consumer confidence, PE bolt-ons, and then Thrasio and some of the aggregators and how that's ended up.
Sounds like a fun time. And thank you to our sponsors, Numeral, Fulfill, Fondue, Iris. Let's jump into it.
All right, Maytab. Everybody knows what we're going to cover here, at least for the first part. Everyone's talking about it. The tariffs that have finally gone into effect yesterday, April 2nd. We are recording this April 3rd. So I want you to give the audience and me, honestly, a quick little primer about what we expected versus what actually went into effect. Maybe just like a little bit of a summary kind of around what did go into effect. And then sort of the implications that you see from here.
Yeah, I think everyone more or less expected tariffs on China to go through. I don't think anyone's overly surprised that there was a round of tariffs that we saw like a month or so ago. But what's most surprising that all these other tariffs were actually pushed through. I think most of the people I know were under the impression that it was just rhetoric and it wasn't really going to happen. It was just posturing, et cetera. But it looks like a lot of those tariffs are being pushed through, and even the methodology to calculate them made no sense. Did you see that? Did you see the method they used?
I saw like the method, but then I saw some people like kind of disputing the method that they use, and they think they use a different method. There was a couple different things flying around.
Yeah, basically, it's like it's not very scientific at all. It's clearly because of the method that they use. It's kind of obvious that they do intend on just using it as a negotiating tool or tactic to quickly get something out of these countries. Some of them are really weird. Like there's tariffs they introduced on countries that are tiny. I'm talking population of like 5,000 people, fishing village. Really, really odd. So I guess we'll see what happens there. In the interim, it's still a little bit weird since the tariffs aren't really high enough to completely move you off of using certain countries. So for example, we're still offshoring one of our brands. We're still shutting down the US factory. We're still setting up the factory in China. It's not going to stop us. And I also feel like the admin probably should have given carrots out first. It's kind of weird, just to go right for the
What do you
stick.
mean by that?
Yeah, what I mean by that is they mentioned giving out tax incentives to people who are manufacturing stateside, but there's been literally no update on that. They just keep saying, yeah, it'll happen for sure. Don't worry about it. Move manufacturing over. And it's like, I don't really care who someone votes for, but the government is not to be trusted. And until they actually go out and do something, I think it's pretty risky to build out a facility in the US where it's just insanely expensive, insanely slow. You'll probably die waiting for permits, et cetera.
So what are the most impactful tariffs that went into place?
I think the one everyone's talking about is probably China. But
Right.
Again, the shockers were stuff like Vietnam, which received a tariff jump that was larger than China. I believe they just renegotiated that this morning. I'm not too sure, but it's literally changing every few hours. It's totally crazy. I feel bad for everyone on the supply chain side of business. I'm sure they're having heart palpitations.
So I want to talk about where this kind of takes everything, right? So
Yeah.
I pulled
Actually,
some.
Andrew,
Yeah.
we'll help the audience with methods on how to increase prices to offset these tariffs at the end. So stick around.
Okay. Yeah. Stick around.
Yeah.
I pulled some data from Iris about category gross margin.
Oh, cool.
So I pulled year over year for the first quarter for 1Q24, 1Q25 gross margins by category. So apparel gross margin last year, first quarter, was on average 64%, which I was a little bit surprised about.
That's a little higher than I thought, honestly. I would have
It was
thought like
higher than I thought,
55
but
or
it's also
60.
gone.
Yeah.
It's gone down 8% year over year. So in 1Q25, now it's at 56%.
And by the way, most apparel brands are using Section 321 to avoid any sort of tax at all. So they're still shipping to Mexico, and then their 3PL from Mexico is basically trucking the stuff across daily, or they're doing that with Canada. So I'm sure as soon as 321 ends here in the next, I think it was May that they slated it to end for anything produced in China, and I think a few other countries, we'll really see that compress for apparel.
Which is brutal because apparel has already been so beat up. And it shows in the numbers here, negative 8% or 8 full points sort of year over year gross margin contraction is really tough to deal with. Durables is down 3% year over year. Health and wellness down 3% year over year. Personal care beauty down 1% year over year. And then pet, electronics, and jewelry are all kind of flat.
Interesting.
And so I think the durables one is probably going to be one that I'm going to keep my eye on. It's just around the China tariffs, and there's a lot of obviously exports from there. Jewelry, I feel like might be okay. Any thoughts on jewelry? We have a weird number of jewelry brands on Iris.
Jewelry typically runs at really, really good margin. Like, what are the gross margins you're seeing there?
Yeah, so jewelry is the highest gross margin at 68%.
Yeah, our jewelry brand that we have equity in right now runs at a much higher margin than that, and it just doesn't matter what happens on the tariff side. To be honest, at that point, like, your COGS can go up, but as an absolute number, they're still so small, even if they doubled, right? If that makes sense relative to the selling point. I think the guys that'll feel it are probably the mid and lower tier. Not even mid, honestly. By the time you're mid-range jewelry, the margins are really good, but lower tier can get a little bit tricky. So,
okay, personal care and beauty. I don't know. I mean, some packaging definitely will come out of China, will be affected.
Yeah, I think that's really it. And then the fill's usually done in the US. So I don't think there's that much there.
Yeah, that's how we did it with Mad Rabbit. And honestly, we probably would have just those kinds of packaging aren't like strictly available in China either. It's not that hard to replace. Yeah, so basically, I'll kind of just like read them off here, and keep in mind, like, this is a data set of probably $3 billion of GMV, so still relatively small. But apparel, gross margin 56%, durables a little bit less than that, 55%, food and bev just under 50%, health and wellness 57.5%, jewelry 68%, personal care beauty 60%, which is a little bit lower than I thought, pet 63%. Electronics 60%. So I think apparels. It's going to be, you're going to want to watch apparel. You're going to want to watch durables, jewelry, personal care. I think will be okay.
Yeah, and I think anyone that was really reliant on Section 321 is where you're really going to see that compression happen.
Well, tell us more about Section 321 first. Let's kind of unpack that. What even is that?
So basically, essentially, you could avoid duties and tariffs by shipping to Mexico or Canada and then exporting from there. And obviously just addressing it to the individual customer, if that makes sense. Especially with de minimis. I mean, even with de minimis, you can ship directly from China as well, right? There's services where they essentially bring it over daily, and the delivery times are actually quite fast, almost US-like, and they'll even just print shipping labels with a return address that is in the US with their US warehouse. So the customer, basically, to them, it feels and it looks like a US shipment, but it's actually originating from China, and there's no duties or tariffs. So all of that's going away very soon in May, and I think that's when these brands will really, really start to feel it.
And like what you say, start to feel it, right? So like let's sort of unpack what feel it actually means, right? So one thing that I've really sort of internalized over the course of the last 12 months in consumer is you are your gross margin. There was sort of a lot of you're not your ROAS kind of whatever going around, but you legitimately cannot outrun a bad gross margin. And so I think taking a step back and just sort of looking at, what are the anticipated changes in sort of like the financial complexion of your business is an extremely important exercise to be doing right now.
So I have a friend who's getting destroyed. He said they have to increase prices by 35% to maintain current gross margins. Um, an increase 30% in price could potentially get them to rev neutral, profit neutral, but they're aiming to do like a 10% revenue bump. Um, they're hoping for 10% revenue bump, 15% profit bump, something like that to offset this. That's kind of what they have to do to offset this. Um,
Yeah.
like you said, it's really tough to outrun changes to your margin. You can kind of get there. Like we have one brand where gross margins kind of sucked initially, and now they're disgustingly good. Like that brand clocked. It went from like kind of 12% ish net to 23% net in March, which is pretty good.
Mm.
It's probably a little high, but like you said, it's just so hard. It makes the business much harder to run, right? You just have to be so much more precise when you're running at sub, let's call it like 15% net even. And obviously like your net's more or less a function of your gross margin. So um, it's just something to be aware of. Like you turn the difficulty up intensely, the lower that net margin is, the lower your gross margins are. Inventory costs more to flow, blah, blah, blah.
Yeah, and I think gross profit is like really the foundation of the entire business model, honestly, in these companies. Like you have to be generating gross profit to support the rest of basically the financial statements, right? Specifically CAC and then inventory, which is like 95% of all the money moving in and around your business. And so I think like one thing that I'm going to be sort of trying to help our customers with, I think, is just helping people understand, okay, like if there is this like, X change in gross margin, what's like the Y change in CAC that you have to be like willing to sort of adapt to
Right.
or tolerate, right? And it just comes back to like the LTV to CAC, sort of calculation of like, okay, like if I had a, $50 in gross profit per order before, and I had a, $40 CAC, there's my, $10 of profit, like that number is going to change. And like, your friend raising his prices by 35% or whatever, like it's not that linear, right? Like you can't just be like, okay, I'm going to raise
No.
prices 35%. Like you're going to see a 60% change in CAC, and
Yeah, exactly.
you may actually be better off not raising your prices, but just like reducing your scale and dropping your CAC. Like there may actually be more leverage in the marketing line, and I think it's going to be and you kind of combine this. Honestly, we should talk about this too. You combine it with sort of the waning consumer confidence. So, I put out a tweet that was like a summary of some of the earnings calls that I listened to, where like Target, Dick's Sporting Goods, Dollar General, Walmart, Lululemon, like they're all calling out sort of weakness in the consumer, right?
Oh
And
wow.
so I think
Yeah, I saw the
it,
Target one. I didn't see other ones. What did
yeah.
Lululemon say?
Lululemon stock dropped like 15% after their earnings. Like it was
Oh
like
wow.
it was a pretty, sound the alarm type moment by
Did
their
you know
CEO.
I've seen Chip Wilson like 3 or 4 times? I don't know him or anything. I just he's in Vancouver as well, so I used to
You've
walk
seen
down
him.
by the beach. Yeah, and I've seen him like walking up and down, and he's a very nice guy. And yeah, he'd always do that beach walk. So that's where I'd see him all the time. And I actually used to
Oh, that's
drive by
cool.
his house every day on my way to work, but he closed the road, so now you can't use that road.
Oh,
So yeah, it's funny.
basically Lululemon was like, we're screwed. Target was like, we're not screwed, but it's going to be tough. Dollar General was like, and I thought this was interesting. It seems to me that the consistent theme is that the lower income bracket, the lower income consumer, is actually under more pressure, which I guess isn't maybe that's surprising in hindsight. But like Dollar General was like, our customers are really feeling it. Walmart lowered their consensus meaningfully on uncertainty. Dick's Sporting Goods is the only one that's very bullish and actually doing very well, which is
That's
interesting.
interesting because the category is not doing well. Like we've talked to a lot of distressed outdoor companies. I know a lot of them had a huge COVID boost, and some of them built up just assuming that was the new normal, tanked afterwards. But that is probably 30% of the distressed deal flow that we see right now is outdoor.
Yeah, I think they've been leaning a lot into like sports apparel and stuff like that. So there might
Cool.
be a little bit of a growth vector there. AutoZone, we think the lower end consumers under pressure and will continue to be under pressure. Williams Sonoma actually was fairly bullish as well. Chewy sounded good. So there's some good, there's some bad, but the overarching theme was definitely the consumer is weakening. And so if the consumer is weakening, your CAC goes up. And then
Yep.
you have Donnie kind of, bumping your cogs by
Screaming.
25%.
Yep.
Yeah. Screaming and crying. So, um, not to be confused with the ghost of your COO, but I just, yeah, I'm kind of, I guess, thinking about all this out loud right now. But you got to have a really good handle on how these changes affect your business, because it's going to be at least a turbulent couple months, I would say, until people start to really gain clarity around the macro picture, which sucks because now the market's nuking and people are going to go kind of on ice. But, I still feel relatively bullish, I would say, in sort of like the medium and long term,
Right.
like years. But I do think the next couple quarters could be
Brutal.
a little choppy, honestly.
Yeah, same boat here. That's kind of what we're modeling. I think long term things will work out, but short term it'll probably be quite messy. Like you said, I read something too about defaults on mortgages, and that data is not looking pretty. So
Oh,
same
really?
with auto defaults. Those are both kind of very bad indicators when things are going sideways. So not
Yeah,
the
consumer credit's like been spiking for like years. I think
Mhm.
there's a lot kind of to those indicators. But yeah, I mean, it's going to be interesting, and I don't know that I have a really great read on it right now. I think the message that we're going to be sending to our clientele is like, you got to keep an eye on that basically variable profit number, because as these new costs start to roll in, you can very easily dip into the red before you kind of realized it. Um, so what are like some of the things that you might do in your businesses to kind of have a better grasp on that?
The first thing I do is I would sign the operators pact. And the good news is, if you're listening to this, you've actually already signed the operators pact. You didn't know it. You get all this knowledge for free. Drew does all this intense research. You're thinking, wow, I get all this value. I don't have to do anything. I've probably saved 5, 6, 7, 8 figures. It's great, amazing podcast, but you do need to pay the price, and the price is the operators pact, which says you have to go to YouTube, you have to subscribe, type in finance operators, smash that subscribe button, and we'll shout you out like Christopher from Artiken, who did just that. And here's his shout out. So be like Christopher, be less like
Shout
whatever
out,
you're doing
Christopher.
now.
Come on the
Go
pod.
to YouTube, smash that subscribe button, make Drew happy, help him impress his mom. Let's get back to it. So,
Okay, but seriously, yeah, tell me, like, what would you actually, after you've completed the operators pact, like, what is Maytab and Card Adventures actually doing?
okay. So you want to drive into the pricing strategies to combat tariffs? We can jump
If
right
that's,
in,
well,
circle
I'm
back to other
asking you what
stuff.
you would do. So tell me
Yeah.
if that's what you would do, then yes.
Okay, cool. So we've actually run into this before. We owned a footwear brand in 2019 or 2020 when Trump did the first round of tariffs. I think they're specific to footwear or something like that. So I believe there's like a 30% hit to our margins overnight, basically. We got lucky there because the founder just straight up increased prices and it kind of worked out. Really funny. But over the years, we'll obviously run into this a bunch. We do invest in distressed companies, so we'll find stuff that has really bad margins and needs to improve pricing, right? So um, let's just dive into this. The bad news is I've learned nothing works consistently, and the good news is we have a bunch of methods you could try, and a few should work. Like, I've never not had at least one of these work. The only caveat I'm going to give everyone is, if you're trying to look at the success of a pricing change, it's really hard. Like you were saying, it's not linear. It's not really that easy to judge. For example, if I increase prices or decrease them, some segments of my customer base will react differently than others. So, for example, if I start increasing prices, I might see a huge drop off with a specific segment, not enough benefit, and think, oh, I can't increase prices. But you might need to just keep pushing them up, right? Until you fully nuke that one segment and you juice more out of the other segment. And then you've built a far healthier business. And then the other side of this is it gets much more complicated when you have a long consideration cycle. So if you do have a long consideration cycle and you drop prices, you see really big performance jump, it just means it's consuming your existing ad stock and you'll start to see that wear off pretty soon.
Mm-hmm.
So that's just my upfront caveat. So let's
So
jump into this.
what's the output metric for you on these tests? Because I have my own answer.
Yeah.
But what like when you determine a successful test, what's the numbers that you're looking at?
Usually gross profit per visitor. is one thing we want to keep a pretty close eye on. And then the other thing we've really noticed is if you increase prices, you can see deterioration in reorder rate and LTV. We saw that actually one company that had a lot of SKUs, we saw that a specific product line really felt it, where I guess we just weren't as competitive on pricing as we were before. And we saw LTV drop off after they received that first product.
Mhm.
What are your views? What would you kind of optimize to?
I would say just contribution margin, all of it.
Yeah.
Just the number of your contribution margin should go up in this. Even if the ratio goes down, even if your contribution margin ratio as a percentage of sales goes down, if the number of contribution dollars goes up, you have performed a successful test.
Right. That makes sense. So let's talk about outright price increases. Touched on this before. They can backfire sometimes. Test it. I like to increase prices a lot, see what happens, just so I get a better feel for how much, like how things move as I increase or decrease prices. Then we'll settle on a rough range, and from there we'll run actual A/B tests usually. That one's pretty straightforward. I don't think it requires too much explaining. The other one I really like is unbundling. So we had a company that sold craft kits. We included some things like a glue stick for free. We took that out. Nobody cared. We removed it. We saved a ton of money. I think it was like low five figures a month or something. Just flowed straight to the bottom line. Um, you can also see that go the other way, right? So bundling, I think True Classic's the one that's really known for bundling their pricing per shirt. If you're buying just one shirt, it's good. It's not great, but what you'll see on their website, especially when you go to the homepage, they really merchandise into their packs to kind of force you to buy four of them. Um, so I would just test this again. I would look at existing data to see what the common numbers that people are adding to cart, where the drop offs are, et cetera. Um, and again, the goal is to make the bundles look really well priced, such that the individual one doesn't look like a great deal.
Hmm.
Fees and services, so increasing minimums for free shipping, increase the amount you charge for shipping, charge for options. Have you ever like spec'd out a cool car? Like if you go to like the Porsche configurator or something?
Maybe once or twice.
Yeah, I mean, it's fun. So you go there, you're looking at all the different paint that's available, and you click on one that looks really cool. You're like, wow, this is great. This is the best color. I'd love to order this color. And you see there's like an upcharge. It's something ridiculous. And there's a reason they do that, because they can. They know people will pay a premium for that color.
Yeah.
So really, you should do the same. Where you can, you should be charging a premium. And sometimes that's shipping speed. Sometimes it's some sort of premium processing. Again, that can blow up in your face. The good news is for for shipping speed optimization, you don't need that much testing, so you can pull existing repurchase rate or LTV by delivery time. So if you see people receiving their order faster in one area and it doesn't impact repurchase, then you should make the slower service the default, if that makes sense. And upcharge for it, because you know there's room,
Yeah.
and you know you probably will not hurt repurchase rates. Um, Good, better, best is totally a real thing too. So if you have a smaller product line, good, better, best kind of lets you anchor. On that note, I'd probably want a few expensive products on my website if I have a larger catalog of products, just to make our main offer look like a really good deal. I don't know. Have you ever gone into like a luxury store before? Like let's say like Hermes or something?
Mhm.
I think they do a really good job of this. So everyone just mentally associates their purses with being like 10, 50 grand or whatever. You walk in, they have like those bangles, I think are an example, or they have some random other jewelry. And you think like, wow, oh, $500 or $1,000 for a bangle. That's not much. It's a great deal. Wow, it's Hermes. It's a great deal. And
Yeah.
that's like price anchoring in effect, right? Like that is not a good price. Or they have like those, have you seen like those things people like to put on purses? It's like a handkerchief type thing. I forget what it's
Yeah.
called.
Yeah.
Yeah, they sell those too, and they're really expensive, right? They're hundreds of dollars, or I think like $1,000 or something ridiculous. I'm sure their margins are absolutely bonkers. And again, that's like price anchoring in effect. People are like, oh, it's Hermes, it's really good quality, it's totally worth it. They just kind of tell themselves stuff like that. The other example is wallets. I think a lot of like Gucci does this, Louis Vuitton does it. They make a lot of money off of their wallet lines, and they can sell them at a premium because people just associate the brand with expensive products, even if that's not where the majority of the profitability sits in the business.
Yeah. Yeah.
Um,
That makes
Obviously, it's
sense.
harder to do that if you're like a new brand, right? You're not going to go out and charge $1,000 for like a little cut of silk, but you can use higher price products to kind of mentally move your brand up market, if that makes sense, and get away with charging more with your other SKUs, your more value oriented lines. Um,
Yeah. So basically, there's a few levers, kind of revenue levers, right? As far as
yep.
like charging for shipping, um, price testing, gross margin levers. Yeah, you just kind of you gotta get sort of swallow that one, I guess, because you just got rugged. CAC levers obviously always exist. And then OpEx levers, I don't know that there's a big OpEx lever that's going to really make a dent in your in your 25% increase in your COGS. So I think you're right to kind of focus on the revenue levers, and try to just get basically more, gross profit per customer.
And then there's other things you can do as well, right? Like eliminate your cheap SKUs. These are usually a net negative, especially if you're selling on e-commerce channels. I think you should really, or if you're multi-channel in general, you should really think through channel product fit just as much as you think through product market fit, right? Like, is it possible to have a bunch of products listed for $30 on my website and actually make money in e-commerce? It's like increasingly hard when your CAC floor is $30-$40, right? It was easier when your CAC floor was $10, but it's tougher now. So I would just look at that really critically. I'd consider eliminating all my cheap SKUs. Again, if you have a big catalog, sometimes it's people that specifically search for the cheapest thing they can buy from you. And you don't really want them as a customer, and you won't actually lose much because they're going to buy whatever's there and is cheapest no matter what.
Yeah.
So you might as well move that floor up and see what happens. The last one's just shrinkflation. I think we kind of touched on this earlier, but most people are not good at perceiving size. You can use that to your advantage if you're shipping. Keep in mind, when you do like shrink something, you can also shrink the packaging. So like your shipping costs should go down, your cost of packaging should go down. So you're consuming less cardboard, and your cost of the actual fill should go down too if you're selling something cosmetics.
I think this is extremely important for Amazon sellers. So like Amazon has like different buckets, right? So it's like if your product is this big, we're going to charge you this much for each shipping. And I've seen people that have like, just change their box size by half an inch, and it puts them back down into like the other category, and they end up saving like $1 per shipment or something. So
you want to hear the most insane thing? So we hired a PhD who had published a research. I was searching up. We had a problem where like a lot of our boxes were collapsing because it was too humid. Well, I didn't know this because they were too humid. But anyway, so I start Googling it. I find this research paper by a PhD on box humidity and like crush.
Where were you getting the boxes from?
This is our supplier in Mexico.
Mexico? Yeah. That sounds like some Mexican boxes.
No. They're good. But like, so what happened is we talked to this PhD, and he helped us optimize the thickness of our cardboard. So it's just barely good enough to kind of prevent crushing and all that. And it actually made a difference in our box size. We still spent a ton of money on boxes there, like way too much. It's disgusting. But it's like you can do stuff like that. You can just try to find, you can reach out to like a bunch of these academics and sometimes get really good rates on consulting to help you build the optimal thickness for your cardboard. So, depends how granular you want to get, but those are real tangible cost savings.
I think this is a good jumping off point, unless you have something else on this topic.
No, I mean, the only thing I wanted to mention is that this podcast is brought to you by Margin, saved by Fondue. We talk about increasing EBITDA a lot, but let's be honest, most brands are leaking it through discounting. Plug the hole. Get Fondue. It replaces discounts with cashback, juices your margins. It's easy to install. It's a quick test, so give it a shot. Lots of brands have used it, like Ridge. You install it really quickly, start doing cashback, test your main offer out, see how it works. It's always worth. Again, really easy to run, so you may as well just try it out.
Yeah, I said just a couple minutes ago that your gross margin levers are probably limited, but Fondue is obviously actually a nice way to kind of combat that. If you can try to just protect the gross margin, even a little bit. I've always been a fan of Fondue, kind of for that value prop. I think it's really profound, and honestly, even more profound probably after yesterday. So give them a try. I want to move on to. And I think it's
Melo Water?
Yes. Well, not Melo Water. Melo Water is sort of like an example of this. And I think we started talking a little bit about sort of like the supply chain and like the boxes and all that stuff, right? So I think, so Melo Water, whatever it is, it's like this like RTD hydration brand, basically like watermelon water. They sell all around, honestly, Chicago at least, in like C-stores and grocery and all that. So they got acquired yesterday by a group called King Juice Holdings, which owns
Wisconsin, right? Are they in Wisconsin?
How'd you know that? Yeah, do you know that?
It just sounds like something that would be from Wisconsin.
Shout out Wisconsin. So, King Juice owns Calypso Lemonade. Do you know Calypso? You'd recognize it.
Is it like the really cheap lemonade?
I don't know that it's cheap. It's in a glass bottle.
Oh no, I
At
wouldn't.
least
I wouldn't drink
sometimes.
it then. I'm not that fancy. I'm more of a plastic bottle guy here.
More of a protein milk guy.
Yeah, caffeinated protein.
Yeah. So anyway, King Juice Holdings, which is a platform company of a $2 billion private equity fund called Mason Wells in Milwaukee, they buy Melo Water. Melo Water, not exactly like a financial success, at least unless something changed dramatically in the last 12 months. They did a crowdfunding campaign in 24 where they had to disclose a lot of their financials. And so,
wait, let's talk about crowdfunding really quickly. Have you ever seen a good deal?
Yeah.
Have you ever seen a good deal on crowdfunding sites?
I think it should be illegal, and people who have done it should go to jail.
Really? I don't think it should be illegal. I think you should be allowed to do it. But I do think it's funny because the deals are always really, really bad. Like, I'm surprised nobody stops to think it's really bad that I'm being pitched this.
Well, I'll just say this. Like, I understand crowdfunding from like a community perspective. And like, if you have like an institutional lead investor for a financing and like you want to open up, like I think Beehive did this and I thought it was kind of cool where like they raised $30 million and, you know, $1 million of it came or whatever from the community. I understand that. Other than that, it is almost always a last ditch effort to rug the public to try to save your business.
Yeah.
And, you know, the Melo Water, you know, I don't know the details of their acquisition. But
I saw a few of those in 2021 and 2022 where they're like very distressed brands prior. And then they launched these crowdfunding campaigns and they were kind of saved. They had like another year or two of runway. It was really funny. And you look at the financials, they're just awful. It was like, yeah, they're doing 10 million a year in revenue or 20 million a year in revenue. But they've lost 10 million to get there or something absolutely crazy.
And they're almost, there's actually, real quick, tell me what is a going concern? Like, what does that mean as like an auditor?
You know what though? Okay, I know where you're going with this, but to be fair, I feel like everyone kind of has to put it in there anyways if they're a relatively small company, just to protect themselves from like the SEC with those.
No, they absolutely do. Yeah. But so what I'm saying is like, almost always you will see the auditor opinion say like this company has substantial doubt as a going concern.
Yeah.
Which basically just means that they're going to go out of business. So if you ever look at a crowdfunding campaign, like make sure you control F going concern and see whether or not they have doubts or no doubts. And you can maybe keep yourself from getting rugged. You're probably already rugged if you've been on this crowdfunding site for too long.
Yeah, I mean, if you want that kind of exposure, you should just go buy some growth equity stocks. Like, dude,
literally just go to like DraftKings. Yeah, like I mean, you're probably better off.
We're now a gambling podcast.
Yeah, and so the Melo Water one, you know, they had $5 million of revenue. They had a safe at a 40 cap in 2023 or whatever. So I don't know that they eclipsed that valuation or not. But the point is, regardless, at the time at least, it was a risky deal to say the least. Anyways, I don't really want to talk too much about the Melo Water thing. I just thought it was interesting that that they got acquired by this, you know, private equity backed sort of platform.
Right.
And I had a bunch of DMs yesterday, people being like, how is this even like possible? And honestly, it has very little to do with like the financials of the brand, I imagine.
Right.
So basically like, Mason Wells Group owns like a logistics they own tons of companies. They own a logistics company, they own packaging companies, they own other brands, they own like distributors, they own all this stuff.
Sorry. So are they a conglomerate or are they an actual PE fund?
They're an actual PE fund.
Okay.
So it's in maybe a little bit of context, like in the Midwest, you have these, where I live, you have these PE funds that own like the manufacturing, and then they own like the packaging, and they own like sort of all the like widgets, nitty gritty type stuff. And then oftentimes they'll also own sort of like the end point, which is the brand. And so, you know, the sort of long story short is that like if you buy something like this Melo Water, you integrate it into your value chain, you can actually unlock tons of margin expansion and generate new business for your, manufacturing company, your packaging company, et cetera, right?
What did they pay for it again? Do you know?
It's not public.
Okay. Interesting.
But I think it's just like it's worth unpacking sort of from like a micro M&A perspective where, even if you have a brand that is not a success really by any measure, I think you can, as long as you're in a decent category, you can oftentimes find a soft landing. And I think that's just important for people to communicate, or for people to understand, and for us to communicate, which is that like you don't have to a lot of times just sort of like fold up shop, right? I mean, like, yeah, I'm sure you probably have tons of experience doing this stuff where, a brand just isn't working out. Like what are like a few things that you can kind of, if you have these few things, you can usually find, a soft landing. I think in the case of Melo Water, it's probably just the category and the brand was actually pretty nice. So like what can you like lean on to find a soft landing if you find yourself in that position?
Oof. Like you said, I think it's really, really category dependent. A lot of companies are in categories where there's just not going to happen. There's not enough strategics. But if you are in something like food and bev, or let's say like beauty, health and wellness, there's usually something that can be done. Ideally, you can kind of try to sell it as a bolt-on product almost more than anything. Especially if there's a good case for kind of plugging your brand into existing distribution or into like an existing value chain, like you said, where they can drop COGS a lot. And by a lot, I mean like you need a big case for building real synergy. What I'd recommend doing really is just keeping an ongoing list, no matter if your brand's doing well or not well. Just keep a list going with a bunch of strategics, add them to it, talk to them, just keep them updated, high level of your progress every quarter or every 6 months. And you'll be surprised, if things do go sideways, who offers to buy your company. Like we were investing in one company. They ended up doing a transaction. Like we sold a bunch of secondary to VC. We kind of got out, but things went sideways like 3-4 months after that. And they ended up getting a lot of inbound interest from that list of people that they'd kept updated. So I think doing stuff like that and making sure that there are pre-existing relationships is really the 80-20 to it, to be honest. It's much better than you showing up out of the blue saying like, hey, we have 2 weeks of cash left. What should we do? And will you buy us, please? And hopefully, you've thought it through. There's some synergy, et cetera. And like you said, if you can kind of get into that value chain and offer immediate wins by combining kind of forces there, you can hopefully find a soft landing. So,
yeah, I think it's category. Even if you have like some IP, probably whether like sort of category agnostic, like even if you're like a durables product, like you've invented like this cool new hair filter or something, there's probably like a case to be made from there. Other than that though, I was kind of trying to think through things that make sense. Other than that, it's kind of like you try to go the strategic route, I guess, and just like basically hope that there's somebody that like likes your brand and is willing to, at the very least, sort of refund your investors if you have those, or otherwise just kind of provide you with like a salary is kind of the lowest end of it at the end of the day. So I thought it was interesting just to kind of touch on like, obviously, large cap M&A is driven largely by like the financial opportunity and all that, but sort of in the lower market, there's just like a couple other factors at play that you may one day be able to kind of leverage to your advantage if you find yourself kind of in that kind of a situation. So the other thing that I think is just semi interesting is you have the geology sort of like micro transaction, right? That happened a week ago or whatever, and then now
the numbers are public now, right?
I don't know that are they public? I don't know if the numbers are public.
Okay, yeah.
There's been some reports that it was in like the 10 million range, I guess is like what I'd say, but that was a strategic called Mega Labs, so that was all published. So like we're talking about like Melo Water, like if I had to guess, like probably not even that. But like these like micro deals that are like kind of happening, and so I think this kind of comes back to like why, the public markets are like always a leading indicator, right? So like public, gets pricing really quickly, and then the privates, usually take a 6 months or 12. Yeah, 6-12 months to kind of, react. And so it all sort of works together. And like you see, again, I think really encouraging signs sort of in the private markets, but now with this public market drawdown, like I haven't really looked at the market today as we're recording this at 10 o'clock.
It was not doing well this morning when I looked.
Yeah, I mean S&P is down 4%. So
yeah. Oh, it's okay. Yeah, drop more.
Yeah, I mean
okay.
that's probably one of the worst trading days in the last 2 years or something. So,
and it's all because of taxes. It's all because of taxes. And let's talk about taxes. Let's talk about sales tax. True. Numeral, our sponsor, makes it super easy. We use it at some of our portfolio brands. We love it. They're much better than the legacy players. Again, there's very much so that feel of going from like 2019 software to 2025 software, and they won't do things like randomly increase your prices 2x, which we had with the legacy player. It was like kind of right after sales tax was like a thing, and then they realized they had more leverage, so they just like increase prices on us. Numeral will not do that to you. Numeral's great. They have a lot of really cool features, like a virtual mailbox they run for you. Since you get a lot of mail from the States, they deal with that. They'll scan it, they'll upload it, etc. They also have a really cool guarantee. Are you aware of their guarantee, Drew?
No.
So basically, if they mess up, they'll cover it for you. So if they make a mistake with the filing and you run into an issue, they will literally cover it for you.
Oh, wow.
That's insane. I think, like Ridge uses them. A few other big players use them. We use them at one or two of our portfolio brands. So I'd recommend them. I feel great about them, especially versus the legacy players that you have kind of floating around.
I would add, I think sales tax automation, like with Numeral, part of the value prop in my mind is that you're freeing up your people to do other things. And sales tax can be so time consuming. Like I actually used to do the sales tax with Mad Rabbit for a little bit. And we had like a Upwork guy that I worked with. But I mean, you're literally talking about at some point, once you reach Nexus, like you're talking about 50 states of filings, right?
Mm-hmm.
And it gets super out of control. And, I eventually hired a controller who was doing that. And then we, implemented software, and it unlocked, so much time and savings and everything else. So it really is one of those things where it's like not using a credit card kind of a thing. It's like you got to sign up for Numeral because you're going to see like instant, profound impacts, not only from a cost perspective, but also from a team perspective. So I'm a huge fan of Numeral. I think it's a really, and they just had a nice benchmark Series A, which, it's a really nice platform, really quality software. I think you should really try it out.
All right, let's jump into a case study today. Do you remember Thrasio?
Of course.
Of course. Well, that was very solemn. So who was Thrasio? What was Thrasio? Who were the other players? Let's just go over that really quickly.
I think so. Yeah, Thrasio, whatever. The e-com aggregators, mostly Amazon. So you had, Thrasio, you had Heyday. Those were. Am I missing one? Was there 3 big ones, or were those 2 big ones?
Yeah, there's one more. I can't remember. Anyways, there's like 10 of these.
There's a couple big ones though that literally raised like billions of dollars, including Thrasio, and I'd like to throw sort of Heyday into this mix because they have that interesting story with that merger with Branded. But basically it was Amazon roll up, right? So they would go around, and Mad Rabbit got these offers all the time, honestly, where they'd show up and they'd say, hey, we want to buy your business all cash. We can close in 30 days, and we'll pay you 3x SDE or whatever sort of metric they wanted to use. Very like sort of low pricing, but quick and cash. So basically,
so you felt pricing was low.
I think Thrasio probably raised.
Sorry, so you felt pricing was low, but that was like VC backed, high growth business with good D2C. Like that's a multi-channel business that's actually high quality. They overpaid for a lot of really mediocre Amazon businesses. Like I had a few friends whose businesses they bought way overpaid for them. Absolutely crazy. They paid like, probably double or 1.5x what they would have gone for a year or two prior. It was kind of crazy. Sorry.
Maybe that was like the real mania. I only sort of fielded those requests in like 2020, probably pretty early on.
Because they mostly acquired brands that were just straight up selling on Amazon, nothing else. Like no real moat, pretty commoditized, if that makes sense.
Yeah, and the thesis was largely around expense synergies and not so much revenue synergies, right? Because they were like, it was kind of like back in the idea of like, hey, we can just like roll together all the accounting and HR and whatever else.
Hmm.
And it's a model that I don't know that I disagree with the model. This approach was obviously horrendous, and we can get into that in a second. But it's an interesting idea. Especially, I think they were maybe a little bit early too, because with AI, it might actually work finally. Um, but yeah, so
Well, there
so
was
to
like
answer,
the one part that did make sense to me was the multiple arbitrage portion. So,
yeah,
they're
yeah.
trying to buy it like, let's just say they were buying it like 2 to 4x. And then, by 2 to 4x, I mean, they're paying like 2 to 4 times seller discretionary earnings or maybe EBITDA for some of the larger deals.
What is tell us about SDE real quick?
It's basically just what you're pulling out as an owner
Yeah. So
with
we'll
add
so
backs. Yeah.
yeah, yeah.
And
Tactically speaking, it's like it's like EBITDA including like your salary, kind of.
yeah, yeah, exactly. That's a good way of putting it. And then, so yeah, like their goal is buy businesses at that multiple and then raise capital or sell parts of the business basically at like, let's call it 10 to 20x. And ended up being something absolutely insane. I can't remember what it was, but that's like kind of the gist of any sort of roll up, right? You're buying businesses that are relatively small, you're merging them into your main entity, and then hopefully you have some level of multiple arbitrage going on. And that's actually, we're working on that right now with like a jewelry platform that we're building. So we're aiming to buy a few businesses with like 3 to 5 million in EBITDA, hopefully have something with like 12 to 20 million in EBITDA soon. And then we'll flip that out at a higher multiple. And we get everyone on board by just showing them, hey, there's a lot of value here created because you'll get a much higher multiple. Let's just say it's 10x instead of like the 5x or 8x you would have got otherwise. So,
I'm thinking about
um,
this as you're talking, and that's obviously all true, and it's a very valid
mm,
sort of PE strategy. Is that what they were trying to do though? Because they were raising billions and billions of dollars. Like they would have had to exit that platform for $20
yeah, the
billion.
goal was, their goal was to go public. And I
Got
know
it.
they sold a ton of secondary along the way. They actually ended up getting sued by the creditors or something like that. It was really
They got
stupid. It was
everyone in that whole everyone in that cap table's been sued.
honestly, I think it was a pretty irresponsible investment. We actually had a bunch of equity and credit guys call us about it, just looking for my thoughts on it. And my thought was that it didn't make sense to me. It's essentially like you're going to Main Street, right, in your town, and you're saying,
Yeah.
I'm buying all the businesses here. There's a lot of synergy. And the reality is, if the front end product's totally different, there's not really any synergy. It's hard to claim that there is. So,
I want to sorry, just I want to you
mhm.
mentioned that like the lawsuits and stuff. Like I think this was like fairly recently, like 3 months ago or whatever,
Oh, yeah.
where the founders got sued. I just pulled it up. I want to hear what you think about this because I think this is so funny. So less than 3 years before, this is the lawsuit that I'm reading. Less than 3 years before the high-flying Thrasio crashed into bankruptcy, the D&O defendants misled numerous equity investors, lenders, and small business owners to invest in a quote-unquote business that they falsely claimed to be worth more than $12 billion. So there was 3.4 billion total, I guess, that was raised, which was squandered by Silberstein, Cashman, and the other D&O defendants, i.e., management. And they also rugged 338 million of that for themselves, which is crazy. I mean, Joshua Silberstein, I
I don't
guess,
know. Like,
made
I don't know if that's really like rug per se. Because I had all these people around them telling them that, oh yeah, this is the future. This is a great thesis. Yes, you guys should take secondary. Yes, it's going well. It makes a ton of
yeah.
sense. And like, I don't know. I don't like the secondary is great. Good for them. And I feel like it's easy to, when you have a bunch of investors and then you have credit as well coming on, who's typically the most cynical conservative. They're just dying for yield, right? In 2021, 2022, they're just trying to deploy as much cash as possible. And you saw them do a lot of dumb deals. And this is one of the dumbest deals. There's a famous special situations lender who's on their, or not spec sites. They used to do a lot of spec sites. Now they don't really. They do a lot of weird stuff, but they're on the cap table. I was kind of surprised. I think they just got kind of loose with what they were doing.
Well, so this
And
is what I wanted your take on is
mm,
like, uh, obviously, like if you lose $3 billion, like there's going to be lawsuits like that. That's what I
yeah,
think it kind of comes down to. But it sounds like you have no issues with what they've done here. Is that fair?
I mean, I think it was like a pretty. I don't really agree with the thesis. I think it was kind of silly for a few reasons that I'll dive into, but um, I don't blame them for taking secondary. If the VC is offering you secondary and if the creditors are okay with you taking secondary, that's on them for being stupid enough to put that there. They're all professionals, right? It's not like they're negotiating against like out of someone with no experience in investing. It's like some of these guys are like hardcore special situations guys. So they know what they were doing, and they just got greedy.
I
They just wanted to
I
deploy,
agree.
collect their fees, and at the end of the day, like that, I think the finance guys are the worst. Like they'll go out there, they'll deploy into really dumb deals, try to rack up as much as they can in fees, and then they'll cry when it didn't go well. And it's like, well, yeah, you kind of did something stupid, so now you're paying the price.
I think this
Um,
is the most beautiful representation of capitalism. It's hilarious to me, and I think that they deserve every dollar that they made. Um, because you said it nicely, kind of like they'll try to pick out when it's working, and then they'll cry when it doesn't.
yeah, exactly.
And
And
people want to sue these guys, but like at the end of the day, like they probably got pressure to take secondary, honestly.
oh, totally, totally. I don't. I'd be shocked if they were not. And I think what's shocking here is in 2022 and 2021, like Amazon lost money on their e-commerce business. So if you just think about it from that perspective and the roll-up's only going to be selling or primarily selling through Amazon, and it's like, let's say it's 95% of revenue, they're losing money on the e-commerce side of the business. They're losing a lot even when the macro environment's good. What has to happen? Fees have to go up, right? So you
Mhm.
saw those fees go up a ton, 2022, 2023, 2024, these kind of keep going up exponentially and margins are compressing a ton. And, a lot of Amazon guys are upset they can't run a business at like 25% net now. I mean, it's like the whole system's designed to commoditize you and squeeze you as much as possible, right? Um, I just don't think it's like a thing anymore. I don't think, I think everyone should treat it like
Amazon.
it's yeah, and like I agree, it's a thing. Sorry, I should say like I don't think starting a brand and just taking advantage of arbitrage by being like the only guy selling water bottle caps on Amazon is like really a thing anymore. You're not going to do like 10 million a year at 25% net. It's just not going to happen. So
Yeah. I mean, I think it's
yeah,
a really great sales channel for a brand.
totally. It's a great
Yeah,
sales
yeah.
channel, but it's not like the days of like that arbitrage guy just printing money off of Amazon. Just not really a thing, right? Anytime you
It
see
was
arbitrage,
yeah, like that's like Amazon brand analytics. They used to I don't know if they do this anymore because not
Mhm.
I'm still one of you at heart, but I'm not really one of you on the day to day. Like, they used to have like this thing where you could like search like brand analytics, and you could
Yeah.
basically it was like product research. Do you know what I'm talking
Mhm.
about?
Yep.
And
Yeah,
that
I
was
still
how
have it. Yeah.
we yeah, that's how we used to kind of come up with some of our products because like we had such a dominant brand, like in a relatively small category, but we owned it, right? So like when
Mhm.
we launched products, like we would just immediately garner all the share. And I don't know if they still have Amazon brand analytics, but it was one of those things where when I found it, I didn't tell anybody about it because I was like, oh my god, this is like actually
Yeah, it was relatively new back then. And I
yeah,
guess
yeah,
like the other problem with the thesis too is you're buying relatively subscale businesses. So I'd say below like they're way below. I want to say like they're anywhere from kind of 2 million to 5 million for a lot of the really small deals. Sometimes even smaller depending on the aggregator. And at that point, there's no founder around or really anyone incentivized enough to care. And if that's one of the smaller companies in your portfolio, you're never going to really give it the resources that it needs. So because of that, anytime there was a big problem, there's no real owner, right? And the brand just
yeah.
languishes. So um, for those reasons, I thought it was a little bit of a silly. It's just kind of silly, right? When someone says, "Yeah, they're all on Amazon, so there's synergy automatically." My answer to like the credit guys and equity guys that called us about the deal was like, if I walk down to Main Street and I tell you there's synergy because they're all on Main Street, that doesn't mean there's synergy. It's just a dumb thesis. And what happens if Main Street has construction or something for a day or not a day, but like for 6 months, right? You're out of a lot of money. So, and I think a lot of them wanted to make a bet on Amazon's retail business, if that makes sense. It's basically like buying exposure to Amazon's e-commerce business, but
Yeah.
I don't know if that was a good thing because again, it wasn't profitable, it was losing money. It really only makes money because of advertising. Like Give to Factor, their ads that they sell in, and then it makes money. But
This was
yeah,
just
totally
like an
brutal.
example of like like money looking for like something. And I think like all your I agree with most of your points, sort of on like the business model perspective and like why the overall thesis is probably challenged. Um, the other component though is interest rates. So it
Mhm.
actually does at some level work in some capacity when interest rates are zero. But they borrow. I think so. They raised 3.4 billion of total capital. I would guess at least half of that was debt. I don't know. I don't know
Yeah,
the
a huge
numbers.
chunk was debt. Yeah.
Half, yeah, call it like half or maybe even 2/3. I don't know. But that cost of capital. So like, it's like classic like LBO stuff where like if the cost of capital, triples or whatever, like, yeah, like you're going to have a much harder time, especially when, like you said, like Amazon's e-commerce, like wasn't even profitable. It's like, you don't have cash to really even start to pay those, interest payments. And so, not only does the sort of fundamental business model maybe have challenges, but also sort of like the capital structure is also pretty delicate itself.
Drew, do you remember like 2 or 3 years ago, I sent you a diagram of our various systems at one of our brands when we were talking about ERPs? Like you're thinking of implementing an ERP.
You send me lots of diagrams.
That's true. So at one point we had like a legitimate diagram accompanying video explainer that was 30 plus minutes long explaining how our ERP, WMS, finance module, et cetera, various systems all work together. It was really gross. Thanks to Fulfill, we solved that in less than a quarter. So if you have anxiety logging into your ERP, which I know you probably do, then reach out to the cats at Fulfill. They're amazing. I've met most of them in person. They've absolutely crushed it for us, even at like a relatively small brand. Level of service is excellent. Hit them up. Let them know that Finance Operators sent you and give it a shot. I think if you're looking for an ERP, there's no better solution. Yeah, like what's kind of happened with Thrasio and the aggregators now? What do you think is going to happen? What does this look like? I mean, it's a lot of capital still sitting there, right?
Yeah, so like Heyday and Branded, which were like two other aggregators, like they ended up merging and now they're called Esser. So it was and it's a gnarly like whole recap. Like they had yeah, I can't even like begin to describe it. Like it was like an insane like Series E like double tranche preferred sort of crazy like bunch of bullshit, honestly. Basically just like everybody got crammed out basically. And so like I honestly don't know. I don't know how you recover from these. I think you hopefully just like sell off probably 70% of the brands that you bought, and then you just turn into like a middle market like platform is like the only thing I can imagine. Do you have a sense for what's the right path forward for these guys?
I mean, I've seen exactly what you described with kind of these disgusting financings. I think they're more or less just going to fall apart slowly over time, kind of be sold and stripped off. And then what's left is left.
How much money do you think they can expect to get back? Like if they just die over time, like is it like a pennies on the dollar thing or like?
I think it's pennies on the dollar. I think there are like a few good brands. Like I know Thrasio bought, Mike from Simple Modern. Actually, I have his water bottle right here.
Yeah.
I think his brother and him started like a pillow company called like the Beckham Hotel Collection or something. It crushed on Amazon, and I think Thrasio bought it initially, and they did really well with it, and it's still like one of the top pillows on Amazon or something like that. They also have another brand called something Orange, something to do with orange. I can't remember, but that crushed it too.
Agent Orange. Agent Orange.
Agent Orange?
Yeah. It's like it's like a cleaning thing, isn't it?
No. Agent Orange is the chemical they used in war.
Oh,
it's Agent Orange.
Wait, what am I thinking? What am I thinking of?
I know it is. It's called like something Orange, and that one ripped too. Like it did really well. So they have like a few of these jewels, and I don't know
angry orange. Angry orange.
So those Agent Orange. I'm like, that'd
be a crazy name for a cleaning chemical. Yeah,
unhinged. Like these will leave you with some serious side effects. So yeah, I mean, like I think some of these will just spit out profit, and over time there'll be some sort of cash flows, but I don't think it really makes sense for like the growth equity type guys that invested in it. Like a lot of VC poured money into it. It's just not a VC play anymore. Doesn't make sense. I think it gets like repackaged and sold downstream or like kind of stripped out.
Yeah, that's like something that I've always kind of wondered. Is like how maybe you'll be able to answer this for me actually. Like how often is a zero a literal zero?
In consumer growth equity?
Like just like anybody who raises, let's say like more than $10 million, and like the business like doesn't work out, like pretty poorly. Like, are investors like generally hopeful that they can get like some money back, or like all the time, or is it like you're happy to get pennies on the dollar kind of a thing?
I'd say most of the time in consumer, there's quite a bit of existing revenue if you did invest in something and you put like a $10 million check into something, and sometimes there's like a profitable business there. Sometimes there isn't really. I will say like the acquisitions that get done when a brand is distressed, they're like the equity is probably out pretty much all their money, just given there's usually quite a bit of leverage, right? Like if you're running
Yeah.
consumer, you're usually running with a pretty decent amount of debt just because of inventory dynamics and how that all works. So
Yeah.
I'd say usually you're kind of cooked if you're a traditional growth equity guy.
Yeah. So, all right. Well, I guess that's that for Thrasio. We'll see how it all plays out. The Heyday Esser merger like just kind of happened last year, so people are still trying. They're still trying.
Mhm.
Whether or not it works, we'll see. But I think it is kind of an interesting sort of case study and just like a massive project that obviously did not go according to plan.
The next thing I want to talk about is right here on my hand. It just says welcome 10.
Welcome 10. Welcome
Yeah,
10. Welcome
yeah.
10.
You know what? Drew,
Welcome
your
10.
brand's too good for using welcome 10 as a simple discount code. Use fondue instead. Cash back feels like a deal, converts like a coupon, doesn't train customers to wait for the next sale. Give it a shot. It's an easy install. It doesn't take much work and it can juice your margins. Bridge uses it. A lot of other guys use it. Totally worth the test.